Welcome back, everyone. In this video we're going to talk about rents, profits, and financial environments. So first things first, we want to talk about what economic rent is. And you may be thinking, well, I pay rent, I know what rent is. Well, economic rent has a different meaning. So economic rent is just a payment for the use of any resource over and above its own opportunity cost. All right, so how do we determine land rent, right? This is what economists used to use the word rent for, right? For rent on land. The concept of economic rent is kind of comes from this brilliant economist by the name of David Ricardo, who, if you've done anything on comparative and absolute advantage, he kind of spearheaded. So economic rent, again, it's just the additional payment for compensating opportunity costs. So economic rent always assures that resources are allocated to their highest valued use, right? So firms or businesses, like individuals, seek to earn the highest possible return. Recall, we were talking a little bit about consumer theory in the previous chapter. Well, we made the claim that consumers maximize their own satisfaction, their own well-being, or utility. This is pretty similar to firms, which maximize their own well-being, their profit. So what is a firm? Well, a firm brings together the factors of production, like labor, physical capital, human capital, entrepreneurial skill, to produce a product or service that it wants to sell at a profit. Right? So this is sort of a definition of a firm again. A firm is a business organization that employs resources to produce goods or services. Typically, a firm has to operate or own at least one plant or facility where it produces its good or service. There are different legal organizations for firms. There are proprietorships, partnerships, corporations, and we'll talk a little bit about them each. A proprietorship is a business owned by one individual who makes the business decisions, receives all the profits, and is legally responsible for the debts of the firm. There are different advantages of this, of course. It's easy to form and dissolve a proprietorship. All the decision-making power resides with the sole proprietor, and profit is only taxed once. But there are some drawbacks. They are subject to unlimited liability. The owner of the firm is personally responsible for all of the firm's debts. They have limited ability to raise funds. Proprietorship normally ends with the death of the proprietor as well. There is also a partnership, which is sort of similar. Instead of the business being owned by one person, they're owned and managed by two or more co-owners or partners who share the responsibility of the profits who share the responsibilities and the profits for the firm, They're individually liable for all the debts of the partnership as well. There are some advantages, of course. They are, again, easy to form and dissolve, and partners still retain decision-making power, and they can specialize more effectively because there's not only one person, there are multiple. And again, profit is only taxed once. Some disadvantages, though, of partnerships is that they are still subject to unlimited liability. Decision-making may be more costly because you may have to bargain amongst the partners, and dissolution often comes when a partner dies or leaves the firm. So now a corporation. A corporation is a legal entity that may conduct business in its own name just as an individual does. The owner of the corporations are the shareholders. They own shares of the firm's profits, and they enjoy protection of limited liability. But what is limited liability? Limited liability is a legal concept whereby the responsibility or liability of the owners of a corporation is limited to the value of the shares in the firm that they own. So there are some advantages. Obviously, limited liability. A corporation continues to exist when the owner leaves the business or dies, and they can raise large sums of financial capital. Some disadvantages is you face double taxation, right? Your dividends are taxed, including the own personal income. And there's a separation of ownership and control, so decision-making is a little more costly. So now we want to talk a little bit about different forms of profit. There is accounting profit, which is total revenue minus total, quote-unquote, explicit costs. And explicit costs are expenses that businesses and business managers must take into account because they must be paid, right? Like wages, taxes, and rent. There are also implicit costs. These are expenses that managers do not have to pay out of pocket and hence don't normally explicitly count or calculate. You could think of explicit costs as like opportunity costs of factors of production that are owned, or owner-provided capital and owner-provided labor. And now we're going to talk a little bit about different rates of return, right? The amount that must be paid to an investor to induce investment in a business is the normal rate of return. It's also the opportunity cost of capital, right? This is the normal rate of return, or the available return on the next best alternative for investment, right? So you could kind of think about, suppose you have some capital. Well, it can be doing maybe two things for you. It can be sitting in the bank earning interest, or it can be lent out to some firm to create some good, and then you would receive some profit or rent on your capital. It's also important to distinguish between accounting profits versus economic profits. The term profits in economics means the income entrepreneurs earn over and above all costs, including their own opportunity cost of time, plus the opportunity cost of capital they have invested in their business. So again, economic profits is now total revenues minus total opportunity costs of all inputs, right? The total implicit and explicit costs. Here's a nice sort of graph talking about these differences. We've already mentioned a little bit about this, but the goal of the firm is to maximize profit. Much like the goal of the consumer is to maximize utility, their own well-being, the firm seeks to maximize their own well-being by maximizing profit. Firms that can provide relatively higher risk-corrected returns will have an advantage in obtaining financing needed to continue or expand production. We would expect a policy of profit maximization to be kind of the dominant mode of behavior for firms that survive. A little bit about interest. Interest is the price paid from debtors to creditors for the use of loanable funds, right? Businesses use financial capital in order to invest in physical capital. So what is financial capital? Financial capital are funds used to purchase physical capital goods, such as buildings or equipment. And interest is the payment for current rather than future command over resources, the cost of obtaining credit. So the interest rate or annual interest rate may vary depending on different reasons, right? The length of the loan, the risk of the loan, if there are any handing charges in making the loan, right? And there are also different types of interest rates. There's a nominal rate and the real rate. The nominal rate is the market rate of interest expressed in today's dollars, while the real interest rate is the nominal rate of interest minus the anticipated rate of inflation. Interest is a price, right, that allocates loanable funds or credit to consumers and businesses. Investment or capital projects with rates of return higher than the market rate of interest will be undertaken. The interest rate performs the function of allocating financial capital and thus ultimately allocating physical capital. Businesses make investments that often incur large costs, right? They need to compare their investment costs today with a stream of future profits. They must relate present costs to future benefits. So how do you do that? The interest rates are used to link present with future. Well, we want to talk about present value. The present value is the value of a future amount expressed in today's dollars. The most that someone would pay today to receive a certain sum at some point in the future. And here's a nice little formula for present value. This is the present value of a sum 1 year in advance, right? Or 1 year later, I guess. And it's the future sum or future sum paid or received 1 year later. And then I is the market rate of interest, right? So it's just this future sum sort of discounted or weighted by this market rate of interest, right? So here's something, an example you can try out to see. And then here's sort of an example for going 2 years, right? Or kind of thinking about different things compounded. And here's sort of this kind of overkill table about discounted present values of $1 at different rates in different years. It's kind of interesting to look at. So discounting is the method by which the present value of a future sum or future stream of sums is obtained. Right? The rate of discount, or the discount rate, is the rate of interest used to discount future sums back to present value. Now, there is no real discount rate. The discount rate is what's agreed upon by the person who undertakes the decision, right? So you may have your own personal discount rate, and your own personal discount rate is going to determine how you are willing and how you save and borrow, right? And the market interest rate lies between the upper and lower ranges of personal rates of discounting, right? Now we want to talk a little bit more about stocks and shares, right? So a share of a stock is just kind of a legal claim to a corporation's future profit, right? A common stock incorporates certain voting rights regarding major policies, decisions, and a preferred stock accords owners preferential treatment in the payment of dividends. And there's also a bond. A bond is a legal claim against a firm. A bond usually entitles its owner to receive a fixed amount or lump sum payment at the bond's maturity date, and bonds are issued in return for funds lent to the firm. There's also reinvestment. Reinvestment is profits or depreciation of reserves used to purchase new capital equipment. Sales of stock are an important source of financing for new firms. Reinvestment and borrowing are the primary means of financing for existing firms. Economists often refer to the market of wheat or market of labor, and these are kind of more conceptual markets that we think about. But for securities and stocks, these can be real locations, right? Securities are like stocks and bonds. You, I'm sure, know some of these, right? The New York Stock Exchange, or the NASDAQ, or the London Stock Exchange, the Tokyo Stock Exchange, which is the Nikkei, the Bombay Stock Exchange, and so on and so forth. We also kind of want to know about this theory of efficient markets, where all information that enters the market is fully incorporated into the stock prices. Consequently, stock prices tend to drift upwards following the random walk theory. The best forecast of tomorrow's price is today's price, plus the effect of any, kind of drift. So the random walk theory, kind of in short, is just this theory that there are no predictable trends in security prices that can be used to get rich. Kind of the best way to predict prices are today's kind of information.